Awesome. Looks like we're all here. Beautiful. Thank you, Shane, and thank you, Sid, for hopping on for this Crypto Tax 101 webinar. Really excited to get started and get all of these questions underway.
Yeah, thanks for organising this, Eamon, and thanks Sid for joining.
Beautiful. Yeah, my pleasure. Thanks, Shane. Eamon, looking forward to providing some valuable information to the audience today.
Would hope so. All right, well, we've got a presentation prepared. So I think, Sid, if you wanted to take off and start enlightening our audience about an introduction to crypto taxes and how it works with regards to the ATO.
Yeah, of course. So I guess today's presentation, we'll be covering cryptocurrency, the buzzword of, I guess, this decade, it seems, and common tax issues that you'll encounter and how you want to report it so that you've got the peace of mind to lodge your tax return and be above board. So I think, Shane, would you like to cover this section?
Yeah, absolutely. Thanks, Sid. So essentially the big one when it comes to cryptocurrency is that one thing to keep in mind is that pseudo-anonymous is not the same as anonymous. So there's a lot of perception traditionally in the market that, you know, if you transact directly on the Bitcoin network, you send crypto to a friend or something, that it's anonymous, that no one will be able to trace it back. But the reality is that as soon as you've done KYC on any exchange, then there's kind of like an audit trail all the way through the blockchain, and it's immutable. That's kind of the definition of the blockchain, and it lives for the rest of time. So it's actually, you know, publicly available information. And as soon as a tax authority is able to gather details and link that back to your on-chain activity, they can see a full trail of everything that you've been up to. So it's quite a difficult place to be getting away with not doing your taxes. It's true that it's very complex to work out what your taxes are, and probably complex for governments, but they are aware of the amount of money being made in crypto, and they do see, you know, the cryptocurrency industry as being a massive tax gap, you know, of hundreds of millions of dollars. I think the US estimated it was something like 28 billion. The ATO's got very high estimates as well. And they're doing a lot to invest in enforcing compliance around crypto taxes. So certainly, like at the moment, you know, they're really still at the kind of warning stage, but we are seeing audits go ahead in the market now. I've seen a number of cases myself, and they're getting a lot more active. So it's really worth trying to get on top of your crypto taxes. Like, generally speaking, the tax authorities are pretty forgiving if you're proactive. But if they catch you blatantly trying to not do your crypto taxes, that's where, I mean, they're really looking for examples at the moment to make an example of.
Yeah, it is a complex environment, right? And I guess in the scheme of things, still relatively in its infancy, and generally regulation lags, you know, innovation. So with all these new products coming onto the scene, different types of transactions, you know, the ATO and other government bodies are putting in place frameworks to ensure that, I guess, tax is taken up on those transactions, which leaves, you know, the common investor and trader trying to figure out what is the best way to stay on top of it. And I think today, you know, we can talk about, you know, understanding those obligations from the tax side, how to record it effectively through CryptoTaxCalculator, and also how to prepare, verify, and lodge your return with the ATO through PubTax. But yeah, this on screen is, I guess, the notifications that the ATO are sending to consumers that they've identified as holding cryptocurrency. So as Shane was mentioning, if it's not anonymous in a sense. For suppliers that you've done the KYC, which is know your client, you've probably set up an account and you've verified your identity through your driver's license and the passport. That is how the ATO are able to link your accounts with what you're doing. So just going to the next page, and I guess today, just to reiterate, cryptocurrency can be a minefield, but together with CryptoTaxCalculator and PopTax, we want to make sure that you're able to get the peace of mind to stay on top of it. So step one, which we'll go through today, understanding your obligations. What should you include, what shouldn't you include? Step two, recording your transactions through CryptoTaxCalculator. And then step three, filing your return through an accountant. And yeah, step four, you're on the road to, to the moon, hopefully. Shane, did you have any comments on anything that you wanted to touch on as well before we get into it?
I think that's a good overview of the agenda for today. Yeah, obviously with CryptoTaxCalculator, the main part that I've particularly focused on is helping people get to the point where they have accurate records. And then Sid definitely helped with the accounting side of things. And obviously, like with CryptoTax, be quite painful process. So somebody like Sid and his services is really helpful to get that kind of professional bookkeeping assistance as well as just filing the tax return.
Yeah, it can be quite difficult. I think a lot of I count myself in this bucket as well. Back in the day, like a couple of years back, you've dabbled in the cryptocurrency market, you've made some trades, and then at the end of the day, you're thinking, okay, how do I actually report this, and what do I do? So I guess understanding your obligations come down to a few key questions that I think in the audience you might be asking yourselves. Do I need to lodge a tax return? Generally, if you're an Australian resident, tax resident, and you earn more than $18,000, you will need to lodge a tax return. If you're a foreign resident, if you earn more than $1 in income, you do need to do your tax return. And then I guess that leads you on to the next question: what do I really need to include? And the common ones, if you've had to do your tax returns in the past, you include your income, salary, wages, interest, profits from any sales of assets. And then on the flip side, what's deductible? So how do I get my tax more efficient and find ways to ensure that your tax is optimized? Deductions like things that go towards you earning income. For instance, if you're a teacher, could be like self-education studies or excursion trips, things like that. But more specifically, to the audience today, do you need to declare your cryptocurrency? And the short answer is, if you've made a trade, yes, you do. Most likely, if you have to exit a position, and we'll go into this more in depth in the following slides. But cryptocurrency, if you've bought and sold, you will have to include it at some level. And then we'll explain, what is capital gains tax? Everyone talks about it. If you haven't traded, shares or investments previously, it might be a new terminology for you. Capital gains is basically the profit you make from buying and selling assets and property. And then second last question, what is the easiest way to lodge my tax return? I think that's what we'll go through today, that 4-step roadmap into peace of mind. And yeah, I guess answering any questions that the audience has today on this whole environment. So what is CGT? As we said, capital gains tax. How does it arise? It arises from selling assets or gifting assets, cryptocurrency assets specifically. Basically, when you buy an asset, there's a cost base attributed to that asset. and say you bought Bitcoin at 10,000 AUD, and then down the track you sold it into fiat, or in the second point you traded for another asset like Ethereum, you would figure out what's the cost, what you're trading at that time of selling out or trading it compared to your initial cost base. And for instance, if you sold it at 15,000 back into AUD, you would realize a capital gain of 5,000 there. Similarly, if you gifted it, there's still tax having to pay on that side. And Shane, maybe you could touch on obtaining goods or services.
Yeah, sure. So, I mean, if you're going to go out and buy goods and services with cryptocurrency, I mean, this is a disposal of the crypto. Some people argue that that's a personal use and it might not be taxable, but it's extremely debatable, and I think it's something really worth talking to your tax professional about. Some perspectives that I've heard is that potentially because you've held the asset for a while and you've made a capital gain or loss, and the reason why you purchased the cryptocurrency in the first place was as an investment, then the disposal of the asset for a good or service is actually a capital gain or loss, because of the nature of the purchase wasn't to purchase the goods, it was to invest and then later purchase things, pretty much like any other type of investment that you make. Probably like other arguments I've heard is like, say if like a concert is only available to be purchased with Bitcoin, for example, and then say you've gone and purchased Bitcoin and then immediately purchased concert tickets with that Bitcoin. I think something like that maybe has stronger arguments, but you really want to be talking to a tax professional about it and being careful about declaring anything as personal use.
I think you touched on a fantastic point there, Shane. It's generally the nature of you holding these assets. Some arguments for personal use is, there's an example where there's a special sale of maybe, call it a computer, and if you paid in Bitcoin, there's a discount there. So your main goal was to get that computer to purchase it. So what you did was swap some of your AUD for Bitcoin and made that initial purchase, and nothing more from there. I think in that case, you would consider that as a personal use asset. And again, it does come down to the argument and the situation you're in, and there are nuances in each scenario. So it is important to discuss these situations with your tax accountant. And the team at Pop Tax have a team of accountants that can help identify and determine what is the best way to record this in your tax return. So yeah, that sort of covers the CGT aspect of the different types where CGT could arise. And I think this brings us onto the next slide on investing versus carrying on a business, which is a very important distinction to make. In most cases, investor is someone that is looking to make hold and make a profit over the long term. Well, I guess it's easier to show, like, if you're more of a business, how do you make sure that you can be counted as a business, which has different tax aspects to an individual. As a business, there's certain things you can claim that you wouldn't be able to claim as a deduction as just a regular consumer. But here's some points on how you can be considered being a business trading crypto, carrying a business. But in some circumstances, you would want to know if it's better for you to be trading as a business or just staying as a regular individual. So some points, like a normal business, you would have a business plan. You'd be acquiring assets, inventory that are in line with the strategies of your long-term business goals. It could be, getting into the NFT market and becoming like a art connoisseur, if that's part of your business plan and you've acquired crypto assets and you've purchased equipment to make sure that you can run a business down that line, then those are arguments that you're carrying on a business. You're actively preparing accounting records, so you might have an accountant, you might have accounting software where you're tracking all these trades and business information. And generally you have a system where it says you're intending to make a profit or genuinely believe you can make a profit, even if you're unlikely to do in the short term. So do you have a special system in place or plans that differentiate you from just a normal buy and sell holder? But I think the distinction today is getting harder now that there's so much information on the internet. There's so much research that goes into trading crypto these days. I think a lot of, Shane, you could probably speak to that point, the hours that go into, reading forums, watching YouTube videos of like why this current cryptocurrency is going to be have a higher trajectory than another one based on like protocols and the team that they're bringing on. But yeah, do you have an opinion on that?
I mean, it really depends on, I guess, how professional as well the activities are. And I think in a lot of ways, like if you're going to be declared as a business, declare yourself as a business versus individual, like are there plans? Is this really a professional activity, or is this more like a hobby, personal investment strategy? It's really the intent there matters a lot, and there's quite a lot of arguments about, it's quite subjective. There's no hard thing about these rules, and Sid, probably you got lots of comments about this, is like there's not like a clear line in the sand of this is what happens and this is where you go. I think there's quite, it's a lot about intent and how you structure yourself. Was it planned to be a business as well, or have you done certain things and then retrospectively you're thinking, oh, this would be better if I considered myself a business at this stage?
That's right. Yeah, and the proactivity involved when you start is important, which does cause a distinction between whether you're just an individual or carrying on a business. And to your point, Shane, people will look retrospectively and say, okay, well, if I was considered a business and I did have these records in place, I would be able to claim all these deductions. But if you don't have anything in place previously, it's going to be very difficult to consider yourself as carrying on a business. And the last point there was you must show repetition and regularity of the business. What that means is, are you on a weekly basis, fortnightly basis, monthly basis, checking on certain things that your business plan is saying? Are you checking the records? Are you making strategic decisions, tactical decisions that are in line with the business plan? Or have you just been trading based on, on a hype train or a momentum trade? So if it's more of the latter, then it's going to be very difficult for you to say that you're carrying on a business compared to an individual. But as we said, it is nuanced, so you'd have to check with your tax accountant. And if one year you said, okay, it would have been better if I was a business, getting advice on how to implement, a record so that in the next financial year, you may be able to be considered as carrying on a business. So yeah, compared to carrying on a business, what does a typical investor look like in investing in crypto? Just buying, selling, swapping crypto for fiat, the everyday trader, unplanned trades, and just there doesn't seem to be a system or procedure in place that is in line with a professional. So I think that gives a clear distinction between the two. So staking, I like to. You might have your own analogy for this, Shane. Staking, but for me, it's like a bank account kind of thing. You invest, you put $1,000 of your AUD into CBA, and then they pay you an extremely high amount, 1%, or if you get that, sarcasm of course, but that is interest earned for effectively staking your money in the bank. Same thing for crypto. So if you stake, what have you staked recently, Shane?
I haven't been staking for a while now, actually. I've just
yeah.
Hopefully you weren't in Wonderland or in Ohm. Feel sorry for those who were, but definitely a lot of rug pulls that happen. Well, not necessarily rug pulls, but got to be careful out there.
Yeah, and I think that comes to separate to a tax situation, but investing and placing your funds, that well-earned funds into the market. You need to really be doing your own research and understanding what you're getting into, which comes into financial planning. Investing can be very difficult. So rug pulls, try not to listen too much to the hype, I'd say. Make sure that you understand the investment you're making. But back to staking, how is it recorded in your individual tax return? Say you staked, say in Wonderland, unfortunately, and what was the percentage there? Or what was the return for that one?
That's a little different because it's an auto compounding token, so it's like 8,000% APY. But if you just let's say stake Ethereum, then it's something more like 20-ish%. So,
all right, let's use Ethereum. So you've staked 1,000 Ethereum, and the what you get in return is 20%. So 20 ETH is coming back to you. How is that 20 ETH going to be recorded in your tax return? It's not CGT. Not at that point. Generally, the consensus is it'll be considered as ordinary income. And the way I liken that to is like interest from your bank account. So if you receive 20 ETH, whatever the AUD equivalent is at that date of receiving it, that will be considered as your income. And that'll just be added onto your, say you had salary and wages of 50 grand, and the staking equivalent, the interest received from that ETH is 30,000. Now your total income is 80,000, which you'll have to pay tax on your marginal tax rate. And I guess one thing to think about, once you do get that 20 ETH in the future, if you do decide to sell it, the capital gain will be the difference between what you sell it at. So say the 20 ETH was worth 30 grand when you got it, but then in a couple of years' time, it's 60 grand. The difference there is 30 grand. And if you take into consideration the 50% CGT concession for holding it over a year, half of that 30 grand will go into your tax return as to pay tax on.
I think that calculation can be fairly complex to wrap your head around. A common thing that I see is like, oh, I'm getting double taxed. I think the point here is that the time when you became the beneficial owner of the, let's call it staking reward or interest, that's calculated really as income. And then the difference when you later sell that crypto, the difference from when you received the asset to when you go and sell it, that's the actual kind of capital gain or loss if you're an individual and you're declaring it that manner. But so the difference is the important point.
That's right.
Also seen like a lot of it's quite complex staking, and you should definitely talk to your tax professional about individual staking contracts that you've engaged with, and how that product is structured, and how that might affect when you might be perceived as becoming the beneficial owner of that interest or staking reward. I've seen quite a few. It's quite a debatable topic. Like really, from who we talk to, you seem to get a different answer every time you talk to someone. But there's some arguments to be made that so say if you deposit crypto into a staking, like a liquidity pool, and you're receiving the staking reward into that liquidity pool, even though that's not going directly into your wallet, you're still the beneficial owner because you've got access to that. And so that's actually the time that you're meant to declare the staking reward. But it's not clearly defined yet that I'm aware of. You can seek a private ruling from the ATO, for example, to get more clarification here. And it might be different depending on the nature of the contract and the pools, etc. It's really complex and actually very hard to work out the calculations, particularly if you were to go down that path, because obviously the liquidity pool doesn't publish kind of the individual rewards, like say every few minutes or every time there's a transaction on say Uniswap. That's not really actually published to your wallet or anything like that. No real record. So it's quite you'd have to go through and somehow try to derive it. That's kind of like a nightmarish situation. Another way of looking, like other arguments I've seen is like if you deposit into the staking pool and get a liquidity pool token, and then you sell it back, the difference is to be considered income. There's probably different ways of looking at this and declaring it, and really you have to talk to your tax professional, see, what's actually possible given your own records, and then make any. The best answer I've seen is like make any revisions to your assessment as more guidance comes out from the ATO, etc. Or particularly if it's significant, to try to get a private ruling. But again, certainly worth talking to a tax professional, particularly if it is significant. Like if you're an ETH whale and you're staking large amounts of crypto, it's worth talking to someone.
Yeah, I think private rulings are definitely the safest way, where they'll give you a judgment on, I guess, what the result should be. It is a complex and ever-changing environment, and as I said, regulation is catching up to it. But who knows when it'll be, black and white. I think we're still quite ways away from there. And the way I look at the crypto market and blockchain technology, it's like a living thing, continues to evolve, and the amount of different pathways you can go down is unlimited. But I think the safest thing for just the regular individual, is do talk to a tax accountant, and as best as possible, report as close to your best guess, best judgments based on the rulings and the information at hand. That way, if, say, you had to pay at the end of the year, let's say $10,000 in tax with regards to the crypto, if the ATO decide to look at it in a couple of years' time, the difference between what you've done and I guess what any revisions need to be, it's going to be a lot less painful if you just avoided it in the first place. So, the ATO are reasonable in a way that as long as you're proactive about it and you're applying the right, tax rules to your situation, they will view that in a positive light. So airdrops, we like airdrops. It's like getting a present, but they're not free, unfortunately. Similar to the previous example, the coins that you get from airdrops will be considered ordinary income, equal to the value when you receive it. And again, say, I think back in the day, it was Theta coin. I remember getting some airdrops of that, and had a bit of a pump recently, which is, after the dump. But yeah, when you get those airdrops, you'll consider that as ordinary income at that time. And when you sell it in the future, similar rules apply. If you've made a gain on it, you'll register that gain, you'll report on it. And if it's a loss, you're selling it for less than what you got it at, you'll take up that loss in your report. Any interesting airdrops for you lately, Eamon, Shane? I don't get many airdrops anymore.
There's been quite a few recently, so it's been a good couple of weeks, but still definitely to be conscious of the tax implications of, especially for the Americans where the tax season ended in December 31st and they wanted to claim the airdrop before or after the tax year. So I know there's a lot of controversy around that one, but yeah, definitely a couple.
So liquidity pools, I'd say one of the most complex, things in the crypto universe right now, given how it changes minute to minute, second by second, depending on the proportions of each type of token, coin in that liquidity pool. This is a minefield, but I think CryptoTaxCalculator does a great job in being able to attribute a value where possible. But in a lot of cases, as Shane was mentioning, it's just impossible. So Shane, how are you helping your customers in getting around this complexity?
Yeah, so it's super complex. Like in the application itself, when you just say if you're depositing 2 assets into a liquidity pool and receiving a liquidity pool token in return, we track it by the smart contract address. So you're actually assigning the value onto the new smart contract address. And then you've really got to try to work out, given, I guess, your personal circumstances or, in conversations with your tax professional as to whether that's in fact a disposal or like some sort of deposit certificate. It's really hard to know what's the most conservative perspective here. Generally speaking, like when we talk to various parties, also on a global level, kind of like the response is that it's maybe perceived as a disposal because it is a new token, which is a liquidity pool token, but it's very argumentative and you really should talk to your tax professional about that. Or even try to get a private ruling from the ATO, particularly if it's a significant amount of money. It's really, I can't emphasize enough how kind of much uncertainty is around this. But there's certainly, I guess the point is that it's certainly something. It's important to be aware that there is complexity here, and entering, participating in these types of financial instruments are most likely going to have some sort of tax impacts. And, there's a risk from your perspective as to what those tax impacts are. And you need to kind of consider that tax risk when considering what the potential gains of participating in that pool might be. Because, if it turns out that it's a disposal and actually that kind of destroys long-term holding kind of values, because you've actually disposed of the asset and later purchase it back when you withdraw it from the pool, that might have that cost from moving from long-term to short-term holdings, or like the price fluctuations or bringing the gain into this financial year, that might actually outweigh the benefit that you're hoping to get from the interest in the liquidity pool. So really worth kind of thinking about the tax risks before actually doing the transaction itself, because afterwards it's almost up in the air as to what the outcome should be still. And I think like the standard response from the ATO would be that you're meant to engage with ATO on complex transactions that could have a tax impact prior to doing the transaction. That's obviously not really like in crypto. If you're trying to ape into the most recent pool, you know, you don't exactly that. You're not on the ATO's time schedule there. You're on like your own schedule to try to get into the market quickly. So you really, I mean, it's just something to really consider and be talking to a tax professional about the different potential views that could be cast here. And yeah, just, you know, there be dragons, basically.
Yeah. Yeah, I think you nailed it on the head. Like before entering a transaction, really understanding the ramifications. You know, you may be doing one thing for one objective, but there's a contradictory, like a balancing side on the tax side, which just completely nullifies any benefit you were initially going for. So really understanding what the product is that you're getting into, and speaking, you know, to someone that will, a tax professional that will tell you exactly what you're doing. But in terms of crypto tax calculator, the product, Shane, you do have the flexibility to record it in various ways, depending on what the right situation would be at that point in time, right?
Yeah, exactly. So it's more like a calculator, so you can kind of configure it how you want. But the choice is, it's choose your own adventure in a lot of ways. Like we kind of provide a tool that allows you to, you know, come up with some sort of calculations, but do you use an addition or a minus button? That's kind of that really depends on your individual circumstances. It depends on the advice from your tax professional. What your, I mean, how do you choose to declare this given the uncertainties? It's really, we don't obviously make any kind of professional guidelines there. It's very much a choice of how, what your input is based on that transaction.
Yeah, and I think, you know, just I can't go on enough about how good your product is to give you that functionality to apply the right application, depending on what you need to do, and then your tax professional will be able to review that and make sure that it's in line with the tax rules. And if a private ruling is needed, you know, they can go ahead and do that. But the platform looks great. And correct me if I'm wrong, you'll be doing a demo later on in this webinar.
Yeah, correct. If we can get some time, certainly.
Yeah. All right. Cool.
Yeah, speaking of the demo, I think we might have to skim past mining real quick and then make sure that we have time for the NFTs, which I'm sure a lot of people are here for, and perhaps fees as well. So
yeah, NFTs. So yeah, you know, you are, it's non-fungible tokens. It is a very interesting, you know, environment, and they do act similar to, you know, purchasing another asset. Proceeds less cost, which is similar to like the previous example. So there's nothing too much different in how the tax, the CGT is calculated on that. But perhaps, Shane, you've got some examples where you think that it might have thrown it off course or confused a few people.
Yeah, so I mean, one thing with NFTs is, like, you know, it's quite common for example, you dispose of 1 ETH and receive 10 NFTs, for example. Also, another common scenario that seems to come up quite a bit is you're an artist and you're producing NFTs for a living, and how that might be significantly different tax implications to whether you're an individual just speculating on NFTs. You know, there's considerations around personal use here sometimes as well. It's a bit less of a minefield than I'd say staking and liquidity pools, but there's certainly one very common scenario that comes up with these NFTs is because it seems to be a different market as well that have been attracted to NFTs compared to the traditional crypto market. A lot of new participants kind of came into crypto for the first time, and their first introduction to crypto was actually purchasing some piece of artwork on OpenSea or something similar, maybe the basketball equivalents. I forget what that's called. And so, because they're new entrants into the market, they run into like this common misunderstanding of crypto to crypto transactions not being a taxable event, or are they not? It kind of takes them some time for it to dawn upon them that the disposal of ETH into an NFT and the swapping of one NFT for another is kind of capital gains, etc. Potentially. And I guess it's just I think a real challenge with this space in particular is just a different and newer type of participant into the market.
Yeah, and I think it comes down to also, the rights of the NFT. I mean, if you're transferring rights of that NFT, is that disposable? Disposal isn't disposal. Most likely, it is. So I think applying the right rules on, the CGT and capturing that gain or loss is important. At least knowing what the difference is, so that when it comes to tax time, you can take the conservative approach. To put you in the best position possible from a tax obligation point of view. But if it is personal use asset, having the right supporting documentation to say that it's personal use, or even if you're an artist, as you were saying, Shane, can you show a regularity? Going back to the original point of carrying on a business, is there a rhyme and reason to what you're doing that fits a business model? Is there repetition and recurrence in that? So maybe if you showed that you were doing a lot of NFT projects over time, and I guess you were showing that you were, that this was your business, definitely that gives you grounds to change the CGT aspect into more of an income aspect. Hard forks, perhaps, I don't know, Eamon, based on time, did you guys want to talk quickly on hard forks? Or
I think there have been too many hard forks that have happened this year. Nothing since 2017, 2018, really, except for Aave, but that was a while ago. So I think if we just skip on to fees, because particularly gas fees have been quite the trend. So Shane, if you wanted to take over for this.
Yeah, so I think gas fees are a really interesting one. Again, probably need tax professional to give you guidance on this. Typically, like the fees related to commission on the sale can be added to the cost basis of the asset. So there's an argument to be made, for example, if you're trading on Uniswap, one perspective I've seen is like, the gas fees from initiating the trade on Uniswap or computing the trade on Uniswap could be kind of seen as a commission and added to the cost basis. I think a really difficult one is like the fees when transferring crypto between wallets, etc. There hasn't been a lot of clear guidance on that from the ATO. If you've got a significant amount of fees, it might be, again, worth doing some sort of definitely talking to your tax professional, that's for sure, or talking to the ATO. For example, in the UK, they HMRC, which is like the ATO equivalent, came out and explicitly stated that you couldn't claim the fees on the mining fees, like when you're transferring assets between wallets, etc. And that might even apply to, initiating the contract, like the smart contract, and you've got to pay an initialization event. So again, complex scenario, particularly on-chain fees. Worth, again, talking to your tax professional about. What we do is kind of lump all of this up so you can then go and talk to your tax professional about how to treat it.
Yeah, and in your platform, you can leave it as, I guess, unreconciled. What's the equivalent? The terminology you guys use in the platform?
Yeah, there's like outgoing and incoming, and you can categorize as a fee itself. And then that can kind of being grouped together so you can highlight that to your tax professional.
Yeah, I guess a rule of thumb is fees are usually included if they pertain to the acquisition of the asset. Is it like directly linked to the cost of that asset? And I guess transfers, there is that argument that it shouldn't be, because you already you're already the beneficial owner of that asset, and you're just transferring it from one place to another, and therefore that doesn't really constitute as a cost of acquisition. So yeah, it is a case by case situation that you'd need to look and talk to your tax professional.
Yeah, the other one that comes up a bit is if you're disposing of crypto. This is a good example right here. If you're disposing of a cryptocurrency to pay for the fee, you've got to consider the difference from when you purchase that cryptocurrency and then disposed of it for the fee as well. And there could be a capital gain involved in that, which would kind of offset the fee. So you could see in this example, excuse this one for being in pounds, but initially it was purchased at £462 and then sold for £2,400. The actual price of ETH. So obviously there's been a gain. It's actually a gain of £31. And so the fee, the total value, is added to the sale here, but then the gain kind of offsets that fee. So really it's more like you're really considering just £8 worth of fees, because it's really more like 39 minus 31 in a lot of ways. And you can see how this is done in the app if you are to import all your transactions. So I'll do a bit of a demo later, just to show you how that kind of looks. But it's definitely worth considering. It's not just, if you purchase the ETH for $10 and then go and sell it for $100 and, use that sale to pay for the fee, well, then there was a $90 gain there. And it's significant. Like some of these gains can add up. So it's worth considering.
Definitely. So I think we covered, out of the 4 steps, understanding your obligations. As everyone can see, it can be complex and difficult to manage by yourself. And I think the next key to making sure that you can get to the end result of being on top of it is, accounting and recording of those trades that you're doing. And, CryptoTaxCalculator does that magnificently. And perhaps you'd like to talk to this slide a bit and then maybe go on to a demo.
Yeah, so I might even just jump straight into the demo, just conscious of time there. Maybe I'll just share my screen. So you guys can see the screen?
Yep, that's all perfect.
Yep.
Yeah, so one thing to point out is that we are based in Australia. We've worked closely with accountants such as Sid and tax professionals. One of our tax lawyers actually used to work at the ATO. So really trying to focus on the Australian market. We do support other markets as well, but very big in the Australian market with Australian-based support as well. You could talk to somebody like Sid and ask them to onboard you into the app, so you actually don't have to do anything, and they can invite you as an accountant into the platform. Alternatively, you can log in, create your own account and do it yourself. But if you do get the invite from your accountant, Sid, you log on this type of page as you log in, and then you add in your exchange data. So for example, finance, and you've got the instructions here, and you can sync via API as well. We've already connected CoinSpot and ETH, for example. So say if we click on Solana, we add the Solana wallet. This is the network, importantly. So you've got like a Bitcoin network or Solana or Ethereum network. And then you've got currencies, or you've got ETH that's on the Ethereum network in a lot of ways. Once you've imported all your data, it's important to really make sure that you do import all your data, because our algorithm, often likes to see both sides of the trade, etc., and that will automatically start to resolve quite a lot of issues. You can see things that still need to be resolved up in the top right here. But as you import more and more data, these numbers will go down. So it's really important that you don't just add one wallet and then kind of freak out that there's still so much work to be done. You just want to try to get everything in there, particularly all your transactions since you first started transacting in cryptocurrency. So, for example, if you initially purchased ETH back in 2017 over the counter with Commonwealth Bank or something similar, you do need that transaction because that will form the cost basis of later sales. So it's really important to get everything in there. So all your old local Bitcoins data. If you're a recent comer to the space, then that's a great position to be in because it would be a lot easier to get those transactions in here and up to date. And the idea is to just regularly try to keep this up to date so that come next tax season, you're not going to have an overwhelming amount of work to do. And it's a little bit like a diary. It's a lot easier to write that diary in recent memory than to look back on, say, 4 years ago and try to work out what you were doing at midnight on Tuesday, November the 1st, 2017, for example, which quite a few people find themselves in when they get a letter from the ATO and try to reconcile everything at the last minute. We can see here we've got a transfer between two wallets, which we'd already imported. So that's automatically picked up. And you could see there's actually a slight gain here because we're considering the disposal of the fee. This goes back to a point that we were making about the fee itself. So you could see, you know, the value initially was $16 and now it's $104. And we're selling that, but there's actually a gain which offsets this gain, and then the fee gets added to the fee associated with the Uniswap sale. So there's quite a lot going on there. And you can see a breakdown of each transaction and exactly how it's being calculated. You can see here again, the fee, the total value is being added to the cost basis. But again, there's it's subsidized in a way because we did make a gain when it moved from $497 to $4,100 and something. You'll see a few transactions. If you haven't completed, we haven't actually imported all the data, so you can see how we've got unknown counterparties here, which get highlighted. If this was, for example, from, you know, maybe you bought this over the counter, you can recategorize it as a buyer, and you've got a lot of different options here. You know, lost, stolen, realized loss, loan repayments, liquidations. You could switch to incoming transactions like minting NFT tokens, mining, interest, income. There's a lot of different things you could do in crypto. We often cover most of them. And then you could see some of the more complex calculations. For example, I'll just take you to page 6. And we could see, you know, a sale, like a purchase of a liquidity pool. And you could see how the disposal here, like the 2 ETH and the 40 trend ring, add up to about $1,900. And you can see how that's kind of assigned to the cost basis here. And you could recategorize that as a non-taxable event or a capital gains event, depending on how you want to perceive it or declare it, sorry. And then you've got different kind of default settings here that you can adjust in the settings as well as different inventory methods. And then once you reviewed all your transactions and all the warnings are cleared, then you've got your overall gain here for this financial year. You can go back to any other financial year. So importantly, when you're looking at the pricing, it covers all previous financial years. So if you did have something, say 4 years worth of tax returns, you know, at least from a software perspective, you're not going to get charged too much. And then you've got your different capital gains reports, for example. You can download these reports. You've got the different options here to download them as PDF or CSV and share them with Sid. But if Sid's, for example, invited you into the platform, then he'd actually be able to see the same view as you and help you reconcile these transactions as well. So a really helpful tool, a lot easier than CSVs and dealing with a lot of different data sources. This just lets you pull in everything, and then you've actually got, you know, a dashboard at the end where you can see what's been going on, what's the cost basis, the change over time, etc. And you can often even uncover some crypto that you forgot about in certain locations as well. So really worth kind of putting this together. And it does take some time to get everything up to date, but once you've got it up to date and you keep it up to date, then most of the time you can sort out your tax nightmare.
Right, great demo, and I think that exemplifies why what you've built is the market leader. Quite comprehensive, and for the experienced traders out there who will know how to categorize their own transactions, it would make your tax time sorting out your tax nightmare much easier, and also save, I guess, the time that an accountant would have to go through and do the bookkeeping. Bookkeeping being categorizing of transactions you don't really understand how it got there. So those are the warnings in the report that you were showing, right, Shane?
Yeah, exactly. And if you're uncertain about anything, then you can easily talk to your tax professional, especially if you're kind of invited and collaborating within the app itself. So yeah, it's just a way of kind of bringing everything together and then working through almost like a worksheet so that you can reconcile everything, and then moving forward, try to keep that up to date.
Yeah, awesome. So, Eamon, I might just quickly spend a couple of minutes on these slides, and then we can move into Q&A. Apologies that we've gone a bit over time, but hopefully we can do maybe 5 to 10 more minutes.
Yeah, sounds good. We've only got about 5 minutes worth of Q&A, so that shouldn't be an issue.
Yeah, great. Is this screen share? Okay, perfect. So I think Shane took you took through step 2, how to record your transactions through CryptoTaxCalculator with a lot of benefits. You can do daily P&L, figure out where you're at, and be sure that at tax time you can provide the report to your tax accountant. And step 3, you can use PopTax as Australia's leading online tax return solution. Built in 2018 in Australia. We've lodged thousands of tax returns, and this year we're making a huge emphasis and focus on the crypto tax market. And similar to CGT section in the tax return, you'll find a special crypto tax return section where you can upload your file, which our accountants can review and make sure that there's no warnings and that things have been reconciled correctly. And you can easily lodge your tax return through the platform. And I think what really sets PopTax apart from everyone else is the max deductible system, which is intellectual property that we've built ourselves, tailored deductions based on your occupations. So if you came in as pilots, like a lawyer, a software engineer, you'll have deductions specifically for your industry. That way you don't miss out on anything. It's fast and easy to use. You can lodge under 10 minutes and has a lot of payment flexibility with buy now, pay later solutions such as ZipPay. And thanks for the Crypto Tax Calculator guys for doing this webinar with us. We've got a special 10% off for our customers. Link will be shared. We'll send a EDM, an email list to everyone that's joined today, so you can avail of this offering for us. But yeah, let's move on to, this is a bit about Pop Business, which is our sister business, which focuses on small to medium-sized businesses. And we help you build your dream business anywhere, anytime. We're in the cloud, we're online, and we have customers all over the country. And yeah, in summary, before we go into Q&A, really remember what your obligations are, but you don't need an expert. You just need to find, solutions like CryptoTaxCalculator and PopTax to help you out. And yeah, best of luck and happy trading.
Beautiful. Thank you, Sid, for getting through those. And also I have sent the link to the offer that you were mentioning earlier. So that's in the chat as well for those of you that are interested. So I think here we'll just go real quick over some of the Q&A, conscious that we don't want to spend too much time going through these. Nothing too confusing. So the first one here from Shintal is, do I have to pay any taxes if I receive cryptos from overseas, whether it's from a family member or someone else? I think Shane, you probably have some insight on that one.
Well, I would. You definitely have to talk to your tax professional. I think. Sid, do you have any comments?
It can be nuanced. It depends on what the relationship between the family members are as well, and who's actually holding that crypto at the beginning. But it's like receiving, it would be similar to like whatever you receive it as, like it's like an airdrop from a family member, I'd say. So although there's nuances, and I double check this, but it's like receiving a crypto. You would consider the cost base at the time of receiving it. So if that crypto was worth $50, $50 would be. I think there's gift between family members that's also not no taxes paid. So yeah, that is a complicated one actually. To give you an answer on selling it though, you'd have to consider what the cost base was. If the cost base was $50, you just have to make sure that you're taking up the difference.
Yeah, which is exactly the situation here. So if it increased in value, you've got to be careful there, I would presume as well. Beautiful. The next one that we have is with regards to cryptocurrency being a personal use asset. I know there's a lot of controversy around what makes it personal use compared to not making an investment. So would holding your crypto in a hot wallet that allows merchant transactions at any time increase the chance of satisfying that requirement to manage CGT?
I just like, why do you have the crypto in the first place? Why don't you just have the AED? That's what's the intent behind that, and that's probably going to be what's going to be questioned. There's all sorts of elaborate structures to try to claim personal use, but if you purchased Bitcoin back in 2010 and held it for 12 years and then sold it to buy a $10 million house from your credit card, the same, you could do that. Like that's. So I think, yeah, I don't know.
This is a hairy one. Thanks for the hairy one, Rob Dunn. But I think, what is the nature of this? I don't know. It seems like it's trying to be like carrying on a business. What is you're holding crypto in a hot wallet that allows merchant transactions at any time. What is the reason behind that? I think that would be the key to answering this question. So without more context, it would be quite difficult to do so.
Yeah, I think like merchant transactions, I think they, like, you've got like your crypto.com credit card or something, and that allows you to purchase things on your credit card with crypto. I don't know. I think probably worth trying to get a private ruling on that one if you really want to go down the personal use case.
Yeah. Yes. And speaking of, actually not so on topic, but we do have something else about, I guess you call it the wash rule now and then that does come up. So what would be the tax implications if I sell some crypto at a loss and then rebuy it after a week? I know the UK and the HMRC have a particular rule, but I'm not sure about the ATO.
Yeah, these are the rules.
So say that again, Shane.
I think that comment, it's really Eamon's top point here is like, there's things to consider here around wash sale rules, and if they apply to crypto, I think that's where the question's angling.
Mm-hmm. Yeah, I think it's a common strategy in the traditional markets and like shares, where closer to the end of the tax year, you would consider selling, your loss-making investments and then crystallizing those losses, which can be used in the future, and then buying it a week later just to, ride that gain in the future. It is like more of a financial investment strategy to manage, I guess, your gains and losses. But yeah, I guess tax implications, the rules would apply, but it's just a strategy you would do to minimize your long-term gains or losses.
Look, it's certainly worth talking to your tax professional about this one. There's definitely rules that I've seen, and this is not tax advice. You've got to talk to somebody about it. But there's rules there that kind of pertain to, like, you know, is this a real sale, or was this sale for the purpose of minimizing your taxes? And it's just really like a superficial sale, and you have every intention of repurchasing at a later date, and you did repurchase it at a later date, and the whole purpose of the transaction was to try to minimize some sort of taxes. So in the, like, for example, the UK and the US, they've got rules around this, particularly like 30-day windows. The rules that I've seen in Australia is they actually don't have that window. So it could even be much longer, is the point. So really worth talking to your tax professional, because what you could be doing here might not end up being what you think it is. I think this was quite popularized in the US. Like, there's a lot of products which talk about tax loss harvesting just before the end of the year. You go and sell all your assets and rebuy, and they were claiming that, you know, cryptocurrency doesn't fall under the security rules, and wash sale rules only apply to stocks and not crypto. So first of all, I know the IRS is explicitly trying to close that loophole at the moment. And additionally, it's also arguable if that loophole is even open or not, because the SEC, I think, claims that Bitcoin and ETH is a commodity, but they certainly haven't declared that, you know, other certain currencies are not a security. Like, for example, XRP, they're actually arguing that it definitely is a security. So, and then, you know, that's a different government agency that's talking about things being securities or commodities, etc. It's certainly not the IRS coming out and saying this one way or the other. So actually, when you really dig into this, it's very argumentative, and I wouldn't believe everything you read on Reddit. That's for sure.
Yes, even if they have 5,000 karma.
Yeah, specifically in the Australian tax environment, haven't read too much about it. You know, any windows. I could be a bit rusty, but the team at Pop Tax, the accounting team that do this day in, day out, will know more about it than I will. But from memory, there wasn't any specific windows that there's like a prohibition of being able to get back into that asset. Could be wrong, but that's why, you know, when you're going through it with the accountant, make sure that you're taking it step by step.
Yeah, the window, just to reiterate, this is more of a US, UK thing. What I've seen in Australia, and again, worth talking to a tax professional, there's actually not it's kind of like the business versus individual rule. It's not a line in the sand. It's more around intents in a lot of ways.
Yeah. And it seems to be a common thread between a lot of these discussions we're having. Like, what's the purpose of what you're doing? Speaking of that, a very similar questions from Sharon is that essentially kind of touching on two different topics. What if you're generating like an NFT as an experiment, just trying out OpenSea, and you realize, oh, I actually have to pay gas fees to actually list it on OpenSea and create this. But how does this change if you do this as a business? So I think whether you create, generate, and list an NFT as personal use and as a hobby compared to a full-on business and it's your own project.
Generally, yeah, the distinction between whether it's carrying on a business or, you know, if it was a hobby and it's being individual, then, you know, the fees that you're paying to mint or anything around that area, if you're going to be an individual, they're generally not claimable. They're not going to be, you know, deductible, whereas in the business it would be. But yeah, case by case scenario as well. It comes down, I think we keep harping on about it. It is really the nature and you know, the intent of what you're doing.
That's why it's also important, if you are doing these type of instruments, that you do try to seek out professional tax advice to consider your individual circumstances. I think it's important to be aware that there are tax consequences potentially, and, you know, understanding kind of different views and options so that you can have an educated discussion with your tax professional about this. Particularly if we're talking about large sums, that's where it really starts to matter as well. So
I'd say some criteria which would distinguish you as a business is, you know, have you set up a personal ABN? Have you set up a business name? Have you put in some plans, I guess, future projects? You've clearly identified a revenue stream, expenses that you may be going to incur in the future, and maybe a strategy about when and how you're dealing with the NFTs. I think with all those pieces put together, and, you know, recurrence of the activity, you could make the argument that you're a business and pick up those fees. But again, you know, definitely talk at length about this with your tax accountant.
Beautiful. Well, after that one, there aren't any particular other Q&A questions that I think we need to bring up. So I think we'd probably wrap it up here. If you're happy with that, Shane and Sid.
Yeah, so thanks so much for joining us, Sid. Really appreciate it. And there'll be details. Eamon will be posting details on how to get in contact with Sid to get some help with crypto tax and get guidance on some of these really complex scenarios. And then there'll also be links about, you know, CryptoTaxCalculator and how to actually kind of keep your records up to date using our software.
My pleasure, guys. Thanks so much for your time. And yeah, if anyone needs to reach out, you can find us at Pop Business or Pop Tax. And you can find me on LinkedIn, Sydney Catchwalla. Cheers, guys. Thanks.
Awesome.